Bang, ladies and gentlemen. We have with us Mr. Sunil Subramaniam, MD and CEO at Sundaram Mutual Fund, joining in. Welcome to the show, Sunil, and always a pleasure to speak to you as well.
Thank you.
Sunil, my first question coming to you is, across, yes, we are seeing some kind of pressure coming in on the back of the macroeconomic fundamentals, which are weak, especially on the inflation front, plus the way crude has been moving, and you have the war between Russia and Ukraine as well, and the lockdowns that are coming in terms of China. That's something which is creating high amount of volatility in the domestic markets as well. And clearly, the fall that we've seen in the month of May, we've seen a lot of wealth erosion that has happened. What's the sense that you pick up?
See, the sense that I pick up is that when you mention the macroeconomic data, right, I'd like to make a distinction between the world's macroeconomic data and the Indian macroeconomic data. Now, the inflation that you mentioned, now roughly the inflation levels between the US and India are the same. But there's a world of difference between the projected growth rates of the US and India. So I would argue that the news for India is not so bad as the news for the US. So paradoxically, Indian economy at a 6 to 7% inflation with a 6 to 7% growth rate, and so a nominal GDP of 12 to 14% is actually in a good macroeconomic wicket. And second aspect is that our growth is not dependent on the US growth, or we have a limited exposure and exports to the US. In fact, China is a bigger trading partner for us, US. So to that extent, Indian growth story is on more firmer footing. That's number one. Number two is the fact is that while generally you expect the markets to react to the economy, right? And what you said, that the bad news around inflation, the bad news around the war, and all those has made the worldwide markets take a tumble. In India, it's driven more by an FPI selling rather than a big correction in our growth story. And the reason I point this out is that if, let's say, the US, where clearly inflation has become more important than growth in the eyes of the Fed and the government, and continues its rate hike cycle, you can almost say that a recession is around the corner. But just pause for a minute and think that what recession would do. Yes, it will hurt to some extent sectors in India which are oriented to the US, like an IT sector, right, whose business may see a drop. But commodity prices will ease. And you say China is also going through COVID-related trouble. Their demand will also come down for commodities. And easing commodity prices are favorable for Indian economy. That's number one. Number two is the fact that Fed, once they achieve their purpose of bringing inflation under control, would have thrown the growth under the table. So that means that they cannot pursue the rate hike cycle for too much longer in a recessionary scenario, which then would be favorable for flows, because India as a market will then look attractive to FPIs. So there is a little bit of a blessing in disguise in terms of the recession that's happening in the US, that Indian markets could actually benefit from increasing flows.
And that's an interesting analogy that you've given us as well right now, Sunil, overall in terms of how India could benefit. So from what you're saying, it's right to say that India probably is in a much better shape than what we're seeing in terms of developed economies like the US. Now, with all of this said and done, would you say that a crisis like this and times like this would be a best buying opportunity?
Absolutely, as long as you keep your focus on the domestic economy, right? So because people tend to go and say, oh, this price of this stock or this sector has corrected because FPIs are selling, it's now at a 52-week low, I'll go and buy. That would be a mistake. I think what you need to keep your mind is, forget about what FPIs are selling. Look at where the earnings growth in India is going to come from. In some cases, it may be FPIs are selling those sectors and stocks, but in some cases, they may not be selling. Hence, those valuations may not have corrected as much. So if you keep your focus firmly on the future, which is a domestic economy driven future, then I would say, yes, this is a very good buying opportunity, because correction happens across the board when liquidity drains out.
Right. And overall with this, in terms of a buying opportunity as well, you have earlier also spoken about, I think a couple of months ago, that this is the time about doubling the SIPs for the next 6 months. Looking at the current setup, what would your advice be?
So I would say stick to the SIP method of accumulation, because the next 6 months are definitely going to be volatile, because one, you need to look at how the Fed is going to hike interest rates. That will lead to volatility. Second is, and I think there's a Senate election in the US around December. So again, news flow around that would impact it. Third, you mentioned the COVID wave in China, how well they bring it under control. Fourth is the geopolitical tension around the Russia-Ukraine crisis. So you have enough news flow, which on a day-to-day basis can cause a lot of volatility, right? So I would actually now recommend that if you can, right? If you, I mean, I said double the SIP, you continue with that. But if your non-SIP allocation, also you can break it down and stagger it. And I would suggest if you take a weekly approach, because the volatility is going to be so much, right? If you spread out your allocation, let's say over 26 weeks, no, what you're doing, your SIP, you doubled it, that's fine. But even what you would otherwise put as a lump sum today, right? When you look at it as a buying opportunity, rather than put it all at one go, I would just split it up into weekly allocations, then you're more likely to get the benefit of rupee cost averaging in such a volatile time.
Right. And that's an interesting strategy to watch as well. And clearly, if you see the FPIs as well, they're selling out, but they are the ones who've invested mainly in the large caps, right? So clearly, it's the broader markets which will potentially see that upside from here on. Is that something that you would agree with? And do you think it would be a merit, to have investments or higher allocations in the mid caps versus large caps?
I would actually put the focus on the sectors rather than the caps. Okay. So for me, the sector allocation, and different sectors have different large cap, mid cap allocation. So if you take, for me, for example, banking as a sector, right? There's a decent large cap allocation in banking and a decent mid cap allocation. So there, you would buy both large caps and mid caps. If you take consumer, right? I would say I'm more in favor of consumer discretionary versus FMCG, whereas FMCG is more in large cap, consumer discretionary is more in mid cap and small cap. So there I would weight in favor of mid and small caps. Now you take infra and capital goods, that's heavily weighted in terms of mid and small cap. So based on the sector call, right, these are the three sectors which I consider to be the future growth sectors. So it's banking and financial services, consumer discretionary, and industrials and capital goods. So in these, I would say that the large cap would largely be in the banking space. The other two sectors are largely mid and small cap. So based on that, I would agree with you that a greater mid and small cap allocation with a medium-term outlook would play favor, but that's because of the sector calls that I'm speaking about.
Right. So apart from these sectors, what would the recent sells be, and what would you avoid from a long-term perspective?
So, I would avoid metals. The reason being that I believe that metals ran up a lot because of the soft interest rate policy and all of that. But with the recession looming in the US, definitely its impact will be felt on the commodity space and the metal space. So if US is actually going to slip into a recession, then demand for metals could fall. And I think the recent correction in metal prices is already predicting that, because the markets tend to be a lead indicator for the economic news that follows. So I would definitely say that this is not a time to increase exposure. In fact, you've already taken exposure to metals. I would say it's time to pare that down. That's one sector that I would say. The other sector that I would be cautious about would be the US-oriented sectors like IT and pharma, right? Where, because the expectation was that a US rebounding would be a huge amount of IT-related demand, and which, we said that the pandemic has made the Internet of Things and a lot of fundamental reset. That, I think, that story will get a bit delayed. So while I would not say sell off IT completely, I would say take a call based on the valuations and be calm about it, and not necessarily, it's not going to be the growth sector of the immediate future.
Okay. And basis valuations, what could be sectors of the future? Because clearly a lot of them already trading at multi-year highs or valuations which are higher than historical average. And which are the sectors as per valuations that you would see which still have the potential?
So I would say cyclical sectors, right? And because what happens is that the valuations always tend to follow earnings. And in cyclical sectors, the past few years haven't been great. So you take auto, for example, right? On the one is there was a demand collapse in auto. Second is there was this margin pressure due to the import the semiconductor component of auto companies' raw material cost actually had shot up, so their margins were under pressure. But because it's a cyclical sector and because the soft interest rate plus the boom in demand means that there could be a V or U-shaped recovery in auto, right? And combined with the fact that with a recession looming in the US, commodity prices and oil prices are likely to ease, then actually it's a double positive, right? So I would say that those valuations will definitely be looking attractive because there's a V-shaped increase in earnings, which is not being factored into the current valuations. So to me, the cyclical sectors are the ones which are looking decent from a valuation. And here I define valuation as growth availability at a reasonable price. So GARP, that would be the way that I would look at the valuation.
Right. And overall, if you see in terms of between the equity markets and the debt market, what's the sense that you pick up? Because you're seeing the way bond yields are moving. You're seeing what's happening with the rate cycles as well. We've already seen a 90 basis point rate hike already in the last 2 months. And to that, inflation has gone up by almost 100 basis points, right? So if you see in terms of the real growth rates as well, that's something which, again, we are back to what we were in the month of, say, March, April. So overall, with an expected rate hike, again, economists are of the opinion another 100 basis points is given in the next couple of months. How do you view that scenario from a bond market perspective, from the debt market perspective?
I think from a bond market allocation, I would say, first of all, you should only put that money in the bond market, which you don't need for 3 years. Right? Because the indexation taxation is one of the biggest benefits that the bond market carries. And if you are investing in that market, it doesn't make sense not to take advantage of that. Right? So I would say first is to take a 3-year call. Second is that just because you're taking a 3-year call, don't invest in a medium duration fund, because the rising interest rate means that you'll suffer mark-to-market losses. Right? So there are two options then in the bond market. One is a target maturity or a roll down maturity product, right? Where since you're going to say that I'm going to stay for 3 years, today the yields are reasonably attractive on a 3-year basis, then you should stay invested for 3 years and not pull out before that. Then the intermediate mark-to-market volatility which will be there in your NAV, right, will not affect you. You will get the indicated yield that's there today in that bond if you stay till the end. That's number one. The other option for you to do is to actually invest in the very short-term funds. Because what happens with the short-term funds in a rising interest rate scenario, they tend to get reinvested at higher and higher yields. So though now the yields may look low, in a year from now, they'll be able to risen. And because those fund managers are reinvesting at every 2-3 months period, you would actually, your portfolio over a 3-year period would actually benefit from that rising yield curve, right? So that's the way I would look at it. But if you don't have an outlook for 3 years, then I would say that you shouldn't be putting in the bond market today, because in a rising interest rate scenario, it's best not to get exposed to those things.
Right. And overall, if someone is just starting up fresh, Sunil, in terms of investments, what's the strategy that you would advise?
For a fresh person, I would say stick to the hybrid category of mutual funds, which have a balance between debt and equity, because the debt gives you a little bit of safety. The equity will give you volatility, but higher returns. And as a first-time investor, right, you don't understand those markets. So I would say a dynamic asset allocation fund, equity hybrid funds, equity savings funds, which have a 1/3, 1/3, 1/3 equity arbitrage, fixed income allocation. Those are the best entry vehicles for first-time investors in these kind of markets.
Right. And very lastly, overall, Sunil, in terms of markets as well, what's the positioning that you're taking right now? Do you think this kind of phase is going to continue for long? Or from when do you actually see or envision that upside to start coming in? Because right now you might see ups and downs. There will be some phases of consolidation that will creep in. But when do you see that stability coming in?
See, that stability will come only when the geopolitical tensions ease. I think the Russia-Ukraine war has to come to a solution or some kind of a standoff or an impasse, so where both of them agree to live and let live, right? I think that if that uncertainty continues, right, then market volatility will continue. So the first is a binary event of the Russia-Ukraine war either stopping and easing or not. That's one. Second point of view is that if the US achieves its goal of controlling inflation, even if there's a recession, right? I think the clarity will be there that then the Fed would switch to a growth supportive actions, right? That will give stability because then you know that FII flows will come back in and commodity prices are going to ease. So that would give a lot of stability. So paradoxically, clarity around the US recession will mean that the expectation of Fed action supporting growth would give a sense of comfort to the markets, and that will give a reasonable period of stability. So these are the two events that I would anchor my future expectations around.
Absolutely. And once these happen, I think probably that's when we will see stability and upside that would come in. But thank you, Sunil, so much for joining us on the show. It's always a pleasure to speak to you, get insights from you, and understand your perspective. Thank you. Stay safe and speak to you soon again.
Same to you and all your viewers.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.